Today, oh, what a tangled web we weave. The DFA Daily to the 31st of August 2021. Hi again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's show, we look at the latest credit numbers. We talk about more savings rate cuts, the costs of new building, why the government housing inquiry is a damp squib, dwelling approvals for July which were down, and so much more. And just a reminder before we start, on our live show tonight at 8 p.m. Sydney time, I'll be joined by Damien Klassen from Nucleus Wealth and also Walk the World Fund, and we'll be talking about the latest economic data and what it means for markets. And you can ask a question live, so join us 8 p.m. Sydney time. Today, CBA announced cuts to its savings accounts, with its popular NetBank savings account now being cut 1.32% since the start of the pandemic. That's just over double the cuts the Reserve Bank made to the cash rate over the same period. CBA has cut savings rates today by 0.07% for its popular NetBank Saver account and by 0.05% for its Goal Saver and Youth Saver accounts. The bank's saving rates have dived since the pandemic began, with its popular promotional rate NetBank Saver account cut 13 times by a total of 1.32% since March 2020, while its bonus Goal Saver account has seen the rate drop 6 times by a total of 0.6% over the same period. This is based on rate changes for a $10,000 deposit. CanStar analysis shows that savers with $10,000 in the bank with CBA's Goal Saver account that has a total rate today of 0.3% stands to earn, just wait for it, $32 in annual interest. With higher bonus savings accounts rates in the market, the annual interest earnings for this saver could be as high as $143 for a rate of 1.35%, or as much as $321 for those aged between 18 and 29 years banking with Westpac's Life account that has the highest rate in the market at 3%. CanStar's Group Executive Financial Services Steve Mickenbecker said the slippery slope for savings interest rates continues today, with Australia's biggest bank cutting the savings rate on its NetBank account on a $10,000 deposit for the 13th time since the pandemic began. Aggregate cuts to CommBank's NetBank savings account since the start of the pandemic are now totaling 1.32%, which is just over double the 0.65% cuts in the Reserve Bank cash rate over the same period. Outside of the months where the Reserve Bank has lowered the cash rate, CommBank's savings rate cuts have largely been in the 0.05% to 0.1% range, which is hardly noticeable individually, but they mount up to a significant hit. Over the period of the pandemic, many retirees have faced increased stress to living standards as savings interest rates have fallen, and the same rate changes have provided only scant help to prospective first-home buyers putting a deposit together. Young savers have not been spared, with CommBank making a 0.05% cut to its Youth Saver account. This gives young Australians even more reason to shop around when the top rate in the market for those under 30 is 3%, a full 2.45% higher than CommBank's offering. There are no great savings rates when compared to the past, but the top savings rate of 1.35% or up to 3% for adults under 30 is still worth chasing. Savers can't afford to ignore the rate slide over the last 18 months. And elsewhere, the National Housing Finance and Investment Corporation has released a research paper which shows that local governments' fees on property developers are increasing the costs of a new home. The report notes that developers' contributions to the cost of financing local infrastructure can add up to $85,000 to the price of a home in New South Wales and $77,000 in Victoria. NHFIC CEO Nathan Dalbone says these levies adversely affect housing supply and reduce housing affordability. And they draw on case studies and shows that developer contributions typically account for around 8 to 11% of total home construction costs, amounting to as much as $85,000 per dwelling in New South Wales and $77,000 in Victoria and $42,000 in Queensland. Developer contributions are increasingly being used to fund social infrastructure like schools and hospitals, areas typically funded by state budgets, in addition to essential housing-related infrastructure like water and drainage, according to the NHFIC. Increasing expectations of good quality local amenities, rapid population growth and funding constraints, such as municipal rate caps, and an aversion to borrowing have left local governments struggling to keep up with the demand for public infrastructure and services, they found. And the NHFIC chief executive said that over time, the cost of funding local infrastructure had shifted from state governments and local councils to new home buyers, potentially adding to the cost of homes in greenfield developments and affecting new housing supply. The expanding scope of developer contributions increasingly act like a tax on new housing, which can impede new housing supply and reduce housing affordability to buyers and renters. The paper found that greater transparency on how developer contributions have changed over time, how they're collected, and the timeliness in which they are spent is needed to build confidence in the system. And new data released by the New South Wales Titles Office shows that the number of people taking out and discharging mortgages across New South Wales has hit an all-time high. In July, more than 27,000 residential mortgages were discharged from New South Wales Titles. That's up 37.1% on July 2020. It comes at the same time residential mortgages registered in New South Wales Titles also hit an all-time high. Just shy of 29,000 home loans were recorded in July, up 41% from July 2020. The New South Wales Land Registry Services Director of Analytics and Insights, Jerry Goldfried, said the record figures of discharges and registrations of mortgages were driven by very strong residential sales activity and record financing volumes. EY Oceania Chief Economist Joe Masters said the household sector had built a war chest of savings, driving strong housing market activity. Households have been awash with cash, she said. Turnover was at a 19-year high and 45% above pre-COVID levels. When you have high levels of turnover, you're going to have high levels of mortgage discharges and new mortgages. The truth is, while Aussies are taking out mortgages at a record pace, they are also certainly fast repaying existing mortgages. The upshot is that overall mortgage growth is growing relatively slowly. And elsewhere, independent economist Saul Eslake has lodged a submission to the Morrison Government Housing Affordability Inquiry. That inquiry, of course, is examining supply-side impediments. And he highlights the crocodile tears displayed by politicians pretending to care about housing affordability. As a multiple of average household disposable income per person aged 50 and over, average residential property prices rise from less than 6 times in the early 1990s to over 11 times by the end of 2017. For the roughly 3.2 million Australian households out of a total almost 4.5 million who owned at least one property, and especially for the almost 750,000 Australians who owned at least one investment property at the beginning of this period, this dramatic escalation in residential property prices was unambiguously a good thing for the additional 2.2 million Australian households who managed to become homeowners during this period, and again, especially for the just under 2.2 million individual Australians who by the end of it owned at least one investment property, and even more so for the 600,000 or so who owned 2 or more investment properties. This huge rise in property prices undoubtedly made them financially better off. But for the 1.1 million Australian households, almost 1/4 of the total, who are living in rented accommodation at the beginning of this period, a number which by the time of the 2016 census had risen to almost 2.6 million households, or 31% of the total, none of this eye-glazing increase in wealth came their way. Between the 1991 census and the 2016 census, Australia's home ownership rate fell from 68.9% to 65.5%. That's the lowest it's been since the census of 1954. But for people aged between 25 and 34, the home ownership rate dropped by 11 percentage points between 1991 and 2016 to a lower level than it had been in 1954, indeed to only 3 percentage points above where it had been in 1947. For people aged between 35 and 44, the home ownership rate dropped by 12 percentage points to a level just 1 percentage point above where it had been in 1954. Hundreds of thousands of would-be first home buyers, a group for whom politicians of all persuasions routinely profess profound concern, were effectively squeezed out of home ownership by cashed-up immigrants and even more by investors able to take advantage of more readily available credit and more generous tax breaks. As always happens in Australia, whenever it is feared that property prices might fall, governments at all levels and of both major political persuasions move heaven and earth to ensure they didn't. And as it always does, it worked. The property price escalator started up again. Indeed, it is hard to think of any area of widespread public concern where the same policies have been pursued for so long in the face of such incontrovertible evidence that they have failed to achieve their objectives. The only plausible explanation for that is that the real reasons for the housing policies which governments at all levels and of all political persuasions have pursued for so long are not the ostensible reasons. For all the crocodile tears which politicians of all persuasions routinely shed about the difficulties facing those wishing to get their first foot on the property ladder, deep down, they know that there are far more people who already own at least one property and who therefore have a very strong interest in policies that result in continued property price inflation than there are who don't, but who would like to and who would prefer, at least until they succeed in their own aspiration, policies which would restrain the rate of property price inflation. And sadly, there's no reason to think that political calculus is going to change. Nor, therefore, are the housing policies which have resulted in the creation of the housing system which Australia has today. Well said. Now, overseas, activity in China's services sector slipped into contraction in August, according to official data released on Tuesday, as COVID-19 curbs weighed on consumption in the world's second largest economy. The official non-manufacturing purchases managed index, the PMI, was 47.5 in August versus 53.3 in July, according to data from the National Bureau of Statistics. The 50-point mark separates growth from contraction on a monthly basis. The figure was below the Bloomberg survey, which predicted a fall to 51.9, and it's the lowest figure since the index slumped to an all-time low of 29.6 in February 2020, after China began lockdowns to control the coronavirus pandemic. Though slower to recover from the pandemic than manufacturing, a gradual improvement in consumption in recent months had boosted the services sector, but a COVID-19 outbreak of the more infectious Delta strain led to strict containment measures weighing on business activity and spending. The official manufacturing PMI, a survey of sentiment among factory owners, fell to 50.1 in August from 50.4 in July. The figure again was below the median forecast of a Bloomberg survey, which had predicted a fall of 50.2. And it's also the lowest figure since the index slumped to an all-time low of 35.7 in February 2020 after China began lockdowns to control the coronavirus pandemic. China's economy grew by 7.9% in the second quarter of 2021 compared with a year ago, while in the first half of the year it grew by 12.7% year on year. But economists have since slashed their economic outlook for China as the Delta variant spreads across the world's second biggest economy after export, retail sales, and industrial production growths all missed expectations in July. And earnings at China's industrial firms in July also slowed for the fifth straight month due to elevated raw material prices and supply chain constraints from extreme weather, as well as sporadic coronavirus cases. The official August composite PMI, which includes both manufacturing and services activities, fell to 48.9 from July's 52.4. Now, back here in Australia, the number of dwellings approved fell 8.6% in July, seasonally adjusted, declining for a fourth consecutive month to be 24.9% lower than the peak recorded in March, according to the latest data from the ABS. The ABS said the decline in the total number of dwellings approved in July was broad-based, with private sector houses falling 5.8% and approvals in private sector dwellings excluding houses falling 12.3%. Since the unwinding of stimulus measures and the return of lockdowns across parts of New South Wales and Victoria, approvals for private houses have fallen 24.4% from the record high in April. Despite the fall, private house approvals remain at elevated levels and are 28% higher than July 2020 and 36% higher than July 2019. Across Australia, the number of dwellings approved fell in South Australia, down 17.9%, Tasmania, down 15.3%, Western Australia, down 11.3%, Victoria, down 11%, and New South Wales, down 9.9%. And dwelling approvals rose in Queensland, up 9% in seasonally adjusted terms. Approvals for private sector houses fell in South Australia, down 23.9%, Victoria, down 7.3%, Western Australia, down 6.9%, and New South Wales, down 4.2%. But private house approvals in Queensland rose 8.3% in season-adjusted terms. And the value of total building fell 15.9% in season-adjusted terms, and the value of non-residential building approvals fell 30.5% to be 47% lower than the peak recorded in March. The value of total residential buildings fell 6.6%, comprising a 7.6% fall in new residential buildings and a 0.1% rise in residential alterations and additions. Now, of course, at the end of another month, we can look at the latest credit aggregate numbers from both the RBA and APRA. And they make quite interesting reading, with the financial aggregates for July from the Reserve Bank showing that overall credit was up 4% year to July 2021 compared with 2.4% last year. And in July, it was up 0.7% compared with 0.9% a year ago. Within that, housing over the last year was up 5.8% compared with 3.2% a year ago. But again, 0.6% in July compared with 0.7% in June. Personal credit was down 5.9% over the year, or comparing that with 12.1% the year earlier, and down 1% in the month compared with June when it was down 0.7%. Business credit, on the other hand, is sitting at 2.4% over the year compared with 3.5% a year ago, and it was up 1.1% in July compared with 1.6% in June. And it's interesting to note that broad money was also reasonably strong, up 7.9% over the year compared with 10.7% in July, and up 0.9% over the month compared to 1.5% last month. But if you take a more detailed look at the information, you can see that looking at overall monthly movements, housing credit was up 0.64%, owner occupation was up 0.87%, investment lending was up just 0.27%, personal credit was down 0.99%, and the business credit was up 1.05%. Now, those monthly aggregates do move around all over the place, of course. Now, if we look at the more reliable annualised credit growth numbers, you can see that overall housing credit rose by 5.78% over the last year, so it continues to move a little higher. Owner occupation was responsible for 7.71% growth over the last 12 months, so it's definitely continuing to move ahead. Investment lending was up 2.33% over the last year, and again is climbing slightly, but still a lot lower than owner-occupied lending. The personal credit growth is down 5.92% over the last 12 months, but more recently, momentum is slightly less weak than it was. And business was up 2.35% over the last 12 months, and that has been quite a volatile ride. Now, overall credit was up 4.05% over the last year, so is moving quite firmly higher compared with last year. And broad money is at 7.9%. which means that it's still continuing to move higher, and there's still a considerable gap between broad money and all credit, something which I continue to worry about insofar that it suggests that a lot of the quantitative easing that's out there isn't necessarily finding its way into the real economy, something which I discussed today in my show with Steve Van Meter. If you want to go and hear him talk about this in more detail, then just follow the link. Finally, as Investor Daily reported on Tuesday, the major bank, Westpac, confirmed the sale of their Lenders Mortgage Insurance Limited arm to Arch Capital Group Limited, and that it had entered into an exclusive 10-year supply agreement with the group. This transaction further simplifies Westpac Group's business portfolio and enables us to help more customers into home ownership, with LMI to be seamlessly integrated into our digital customer journey with a partner that has a long-standing relationship with Westpac. Westpac Chief Executive Specialist Business and Group Strategy Jason Yetten said, "The sale, which was first announced in March, is at book value and expected to be around $350 million. It'll add about 7 basis points to Westpac's common equity Tier 1 capital ratio. And it comes only weeks after Westpac had also completed the sale of its vendor finance business to Angel Finance. And Westpac's indicated all remaining businesses in its specialist division, which was created in 2019 and includes BT and Westpac Life Insurance, will be sold off as part of a broader cost-cutting and simplification strategy." In its half-year results presentation in May, the bank said it would target an $8 billion cost base by 2024, with the offloading of specialist businesses to form a key part of that cost cutting. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.